Hello guys, in this video we're going to be talking about 3 dividend stocks to buy in 2024. The first one is going to be Hershey's. Hershey's ticker symbol HSY is down 12% this year. The main reason why Hershey's is down this year is because of cocoa prices. As cocoa prices rise, it makes it more and more expensive for them to create their products. But looking at their income statement, you can see they're making plenty of money, and it's been consistently growing since 2013. In 2013, the revenue was $7.1 billion, and in 2023, it was $11.2. Same thing with their net income. Their net income was $784 million in 2013 and was $1.9 billion in 2023. So all around, they've been growing very, very nicely and consistently. Looking at Hershey's margins, their margins have been consistently stable throughout their history. And looking more recently into their net margin took a little bit of a dip from 2022 being as high as 17.7% to down to 15.8%. But now it is currently back up to 17.1%, which is actually above their average. So these short-term cocoa prices didn't really affect it that much, and it looks like it's already rebounded from that. Taking a look at their dividend, they have a 2.3% dividend yield and have been given a 93% dividend safety score from Simply Safe Dividends, which is considered very safe. Looking at their payout ratio, they have a 45% payout ratio and a 49% forward payout ratio, which is very good. This means they have a lot of room to continue increasing the dividend and investing money back into the business. Looking at their dividend growth, they've had very, very fast dividend growth. In the past 5 years, they've been growing their dividend at 9%, and in the last 20 years, it's been growing at 10% per year. Looking at the graph, you can see in 2014, it was a little less than $1 per share, to now in 2022 being almost $4 per share. So as you can see, Hershey's is a very large and stable company that has continuously grown over time, and as cocoa prices go down, they should continue to increase their profits. And the second stock we're going to be looking at is Starbucks. Starbucks is currently down 13% this year. Starbucks is mainly down because of short-term headwinds, mainly employees' unions and protests about the Middle East. Looking at their income statement, though, their income statement still looks phenomenal. Looking over the past 10 years, you see the revenue grew from $15 billion in 2013 to a staggering $36 billion in 2023. And their operating income also from 2014 it was $2.1 billion, and in 2023 it was $4.1 billion. So it has also doubled in the past 10 years. You will see this dip in almost all their analytics in 2020, which was because of COVID. But in general, they have rebounded very nicely. Looking at Starbucks' margins, they have a 27% gross margin and a 15% operating margin. Looking at their margins, they've been consistently stable over time besides for the dip during COVID, but the one that isn't is the net margin. The net margin is all over the place. Looking at the net margin, it was as high as 19.3% in 2018 and as low as 2.9% in 2020. That is obviously because of COVID once again, but then it started recovering and slowly started dipping down again. It has started recovering again from this dip in 2022, which was as low as 10.1%. It is now currently a 11.5% net margin, which isn't bad, but once again, this net margin has been moving all over the place and is definitely something to keep an eye on in the future. Taking a look at Starbucks' dividend, you see they have a dividend safety score of 67 from Simply Safe Dividends and a dividend yield of 2.4%. Looking at the payout ratio is 61% and the forward payout ratio is 55%. These are on the higher edge for restaurants and food businesses, but in general, it is pretty good and there is still room to grow the dividend. And looking at the dividend growth in the past 10 years, it's been incredible. In the past 10 years, they've been growing their dividend at 17% per year. In the last 5 years, at 10% per year. Looking, you can see they started the dividend in 2009, and since then, they've grown it to over $2 per share. They've also been growing their dividend for the past 13 years straight without any decreases. So overall, Starbucks is a really high quality company that just has some short-term headwinds. They should have a very, very nice 24, assuming they live up to their guidance. Looking at Starbucks' 2024 guidance, you can see that they're betting heavily on China doing well. They're expecting China's store growth to be 13%, which is 9% more than what they're expecting to grow in the US. So they're really placing a lot on China, and they're planning on building 3,000 stores in China by 2025. And guys, just a quick reminder, if you guys like the content, please make sure to like and subscribe as it really helps out the channel. And the last stock we're going to be talking about is VICI Properties. Ticker symbol VICI. VICI is down 11% this year. For those that don't know, VICI is a real estate investment trust, which means it's a REIT, which specializes in casino and entertainment properties. VICI owns some of the most popular hotels and casinos in the world. These include Caesar's Palace, the Venetian, and the MGM Grand in Las Vegas. Looking at VICI's revenue, you can see a crazy growth streak from in 2018 being $900 billion in revenue to having $2.6 billion in revenue in 2022. This is a 43% 3-year CAGR and a 24% 5-year CAGR. And the same is true for their net income. Look at their net income in 2018, it was $523 million, and in 2022, it was $1,117 million. So they've over doubled their net income. Taking a look at VICI's dividend, VICI has a 5.53% dividend yield. This is the highest of the three stocks we've talked about today. They also have the highest payout ratio at 75%, which is on the higher edge for the REITs, but they're continuously growing their free cash flow, so I'm not nervous about this. Looking at their dividend growth, they spun off in 2017, so that's when they started paying a dividend, and it went from $1 in the first year up to $1.50 per share in the past 5 years. They've been growing their dividend for the past 4 years, and they've been growing it pretty quickly. Looking at their dividend growth rate over the past 5 years, it was 10%, and over the past 3 years, they've been growing it at 8.6%. The reason why VICI is down this year is because real estate is down as a whole this year. The reason why is because the sentiment for real estate is down as interest rates have risen. Since it is likely that interest rates will be cut in 2024, VICI should have a very strong year as the real estate market rebounds.